So what are we trying to cover on this presentation? We will cover the overview of personal taxes in UK and understanding your individual tax brackets and the income levels associated with it. Taxable and non-taxable income. There's always a question from our clients, which ones are tax and which ones are non-tax. So we'll briefly cover those points. Foreign income and UK taxation. Very, very important point on this one is, there's lots of assumptions being made and a lot of friends tell different things, etc. So we will cover and give some clarity on that foreign income part. Tax reliefs and allowances. We want you to obviously utilize some of these allowances. Also want you to understand, what reliefs are available out there, and if you are not currently utilizing them. And also, we'll cover the self-assessment and filing requirements. Who needs to file. What needs to be disclosed, etc. And the penalties and compliance. And nobody likes the word penalties, but we like to give a bit of a idea of what penalties you can expect if you don't keep up with your filing requirements. And a few recent changes within UK tax legislation. Again, as I said, there will be significant changes out of the budget next month. And finally, we'll close the session with some questions and answers from the participants. Overview of personal taxes in the UK. So before jumping into that, a lot of you, I'm sure, currently file a self-assessment. So the first question to answer is, what is a self-assessment? A lot of us, if you're getting paid through PAYE, you already taxed then and there, so you don't have to file a tax return, for most of the cases. But if you are not taxed then and there, and if you have income, outside of PAYE, such as dividends, etc., or buy-to-let, etc., you need to file something called a self-assessment return. This is the process of filing income taxes. And for anyone who's either self-employed or have any other additional income. Who needs to file? Some people do not work under limited companies, so they work on their sole trader basis. So if they're self-employed and their income is more than £1,000, or partners, or somebody who's in the business partnership, not via limited company, but as in individual partnerships, company directors, individuals with rental income or foreign income, private pension contribution that require additional relief. Some of you might be on PAYE income, and some of that PAYE income might, you might be paying to pensions, etc., which might be requiring additional relief that you need to claim. So that has to be claimed through self-assessment return. BCT investments such as EIS, CIS, etc. Again, you need to claim that through the tax return. So you need to file a self-assessment return. And those with high income and other specific circumstances, especially somebody who wants, more than 100,000 or more than 150,000, who has a different tax codes over the month. So, we always recommend them to file a tax return. And also, finally, if you receive a child benefit and, if you go above 60,000, you are required to file a tax return to, repay that child benefit. Yeah, so understanding your tax brackets and income levels, we always get questioned on this one, especially when you take dividends and if you have other incomes. So personal allowance is 12,570. So up to that amount, you do not pay any tax. So that's the personal allowance everybody gets. Obviously, that will change if your income goes above 100,000. So if you earn £2 above 100,000, you will lose £1 on your personal allowance. So somebody wants 120,000, the personal allowance will be, only 2,570 because the 20,000 they earned above 100,000 will reduce their personal allowance by 10,000. So that's very important to remember. Basic rate is somebody who earns between 12,000 to 50,000, all the income. So if your income is PAYE, buy-to-let, dividend, etc., up to 50,270. If you're on PAYE or rental income, you'll pay 20%. If you're on dividends, you'll pay 8.75. If your income is above 50,000, up to 125,000, you pay 40% tax, and above 125,000, you pay 33.75 on your dividends. And the additional rate used to be 150,000 a few years ago. Now it's only 125,000. So if you earn more than 125,000, you pay 45% tax on your income, on excluding dividends, and if your dividends is above that amount, you'll pay 39.35. Then I already covered the point on the reduction on personal allowance when your income goes above 100,000. And the next thing is the savings. So savings it goes in line with basic rate and higher rate and additional rate, but the savings have a slightly a different allowance. So, for example, first 5,000 on savings is tax free. So, if you earn, somebody earns up to 17,570 solely on savings, they won't pay any tax. But if they earn more than that, obviously they'll fall into those brackets. And if you're a basic rate taxpayer, and if you have £1,000 is your allowance for savings. So if your dividends and your salary say adds up to 40,000, and you get £2,000 as savings, first thousand is tax free, and the rest of the 1,000 you pay 20% tax. And on your higher rates, your higher rate taxpayer, your allowance is only £500. Obviously, you pay 40%, and if you're additional tax rate owner, you pay 45%, and there's no allowance. Again, important point to remember here is if you have income on your ISA savings account, that's completely tax free, so that doesn't come into that calculation at all. You don't even have to disclose on your personal tax returns. So if you have savings income, if you are not utilizing ISA, it's worth considering having a savings account under ISA schemes. Yeah, thank you, Moksha. Taxable income is adjusted to, taxable income is the portion of the income tax that is subject to income tax. It's calculated after, all the allowances and deductions. So when you calculate the taxable income, you need to go through the certain hierarchy, right? Which ones goes in the first in the calculation, which one to second one, etc. So salary and bonuses, the top on the list. So the other first one get calculated, and they're the first one to pay tax. Then the pension income, if you're retired and if you're earning a lot of income from your pensions, again, that's similar way as a salary and bonus. Then the rental income, then the self-employed income, the interest income, dividends, and finally capital gains. So that's the hierarchy of the calculation happens. Foreign income and UK taxation. A lot of us, either be non-domiciled to UK or moved into UK recently. So sometimes very, very confusing when it comes to foreign income. So we want to clarify a few things here. Again, we are not touching deep end of it, so just on the surface. But if you have any questions, if you want to understand more, please fire a question to my team members. I'll be happy to talk you through on your personal circumstances, because we understand everybody's personal circumstances are very different, right? If you are the types of foreign incomes, obviously, you might have foreign earnings like salary, wages, so self-income from abroad. You might have foreign property you earn interest in that country. You might get interest dividends from some of the savings you have in the foreign country, and you might have some pensions that you get in outside UK. So all that are categorized as foreign income, right? And there might be other two that's not in this list, but anything that you earn abroad is foreign income. Whether you need to pay tax on that income depends on the UK tax residency. So when I say tax resident, if you live in UK more than typically 183 nights, you are a UK tax resident. So if you are a UK tax resident, you need to pay tax on your global income. So whether you earn income in France, whether you earn income in Germany, whether you earn income in India, if you're a UK tax resident, you need to pay income in UK. Obviously, based on individual countries' double tax treaty agreements, you might get some allowances, some reliefs, but the key point is you need to pay the tax in UK if you're a UK tax resident. The confusion arises whether you're a domicile to UK or non-domicile to UK, right? So domicile is a funny thing. It keeps changing, and it used to be 15 years, now it's 5 years, etc. So domicile is your country of birth, or where if you lose the residence in UK, your citizenship in UK, where you will move back to. So that's the domicile. So again, understanding whether you're domicile, non-domicile, or deemed domicile, etc., is very, very confusing. If you are if you choose to be a non-domiciled of UK and choose not to pay the tax in UK, you can use something called a remittances basis. But if you do that, you will lose your personal allowance in UK. So it's very, very important. If you make that election of a non-dom as a UK tax resident, you will lose a 12,570 if you use a remittances basis to disclose your income. But if you use a rising basis, meaning if you are disclosing all your global income in UK, even though you're non-domicile, you can still utilize your personal allowance. And foreign, again, going back to the same point. So the next question is, what is a tax residency? Again, here I'm only touching the tax residency, nothing about domicile, non-domicile. So tax residency determines which country you are liable to pay tax in tax based on your residency status, right? So you need to, in UK, you'll be considered UK resident if you meet two criteria. One, you meet at least one automatic test or sufficient ties test, or you do not meet any automatic overseas test. So there are two tests we need to consider. So UK residency test is if you spend more than 183 nights or 9 days in UK, you're a tax resident. If you spend less days, for example, 91 days, but if you have other ties, etc., there's a table that we'll go through. So we'll have to ask questions about whether you have a family home, whether your family lives in UK, etc., etc. So there's certain ties that you need to go through to understand whether you're a tax resident in UK or not. And overseas test, this is saying if you live in UK, but if you have an overseas residence and less than spend 16 days in UK, but 46 days if you're a tax resident in previous years, again, you need to consider those points also to come up with this, right? So this is, as I said, very confusing part, but our assumption is a lot of you are UK tax residents, and some of you might be UK tax residents with certain non-domicile part, or you might be deemed domicile because you've lived in UK for so long. But important part to remember is if you have foreign income, speak to us and try to disclose it in UK, because the penalties are very, very high if you do not disclose them, right? Because there's part that some of the time you might disclose, there might be not any tax to pay because of the foreign tax relief. But the assumption might be that you might think, I paid the tax in foreign country, I don't pay tax here. That's wrong. So in UK, everything is self-assessment, right? So they expect you to be a very honest and do a honest job by disclosing all that. So if you don't disclose, the penalties are high. If you disclose, you might not even have to pay a tax on it because of this reliefs, etc. So it's very important if you have foreign income, always disclose on your self-assessment return. Jumping back to tax reliefs and allowances, very important to understand, what tax reliefs and allowances are available for you on your income tax. So we're not talking anything about your company, just your personal self. Personal allowance, we already touched this point about 12,570. And we also said, if your income goes above 100,000, in every £2 you earn, you lose £1. So that was covered in earlier slide. Marriage allowance is, if you're married, your spouse can transfer part of the allowance to you up to 1,260. Key point is, you have to be basic rate taxpayer, so it's not that significant, but something for you to think through. A blind person allowance, if you are registered as a severely sight impaired or a blind, your current limit is 2,070. So you have additional allowance for that for blind people too. Annual exempt allowance. So capital gains, as I told you, is a separate calculation. So it goes as a, if you have a second home, or if you bought some crypto a few years ago and you're selling it now, etc., etc. So those are capital gains. So capital gains allowance used to be 12,300 a few years ago, got reduced to 6,000. The current is only 3,000. So if you, for example, if you sell shares, you paid 20% tax on, if you're a high taxpayer, on the gain that you make. And if you own a second home, and if you sell the second home, if you made a gain more than 3,000, you pay 24% tax. Trading allowance of £1,000. So that's out there if you want to, buy some stuff on eBay or Amazon and trade. First £1,000 is tax free, but anything above, will be taxable. This £1,000 can also be utilized against your buy-to-let incomes. If you have buy-to-let income and if your expenses don't add up to £1,000, which is very unlikely, but if you don't add up, you can use these £1,000 rather than using the actual expenses. Reliefs and allowances. So other relief is rent a room relief. So if you have a lodger in your house, and if you're earning some rental income from the lodger, up to 7,500 is tax free. Again, this is per household. So if you're husband and wife, and if you're renting a room, it's not 15,000, still 7,500, as long as that person lives inside your house and on a furnished letting. Pension contributions, again, a big topic. So when you contribute to pensions, you get tax reliefs. The pensions can be contributed in multiple ways. Some pensions comes off with gross salary, so you already take the benefit on the tax calculation on your salary. Some of the pension contributions goes from the company, so again you get a corporation tax relief. So there's no personal tax relief on that. Some pension contributions comes off your net salary, or some pensions contribution only give you a 20% relief on your salary. So those circumstances, the additional relief should be claimed through self-assessment return. So pension is an important thing for reducing your personal taxes. Gift aid, if you pay into the UK registered charity, every £1 you pay, you get 25 pence as a gift aid relief on your tax return. Again, please disclose, and we can claim these reliefs on your tax return. The other main point is the EIS, CIS, VCT funds. So these are things where you can invest. So enterprise investment scheme, seed interest scheme. You might have friends who develop a software who are looking for the funding, and they might want you to come as a shareholder, invest some funds in their company. So effectively, you are buying shares in another company. So if you do, and for those ones, some of those company might be EIS, CIS approved by HMR. So if you invest on those ones, you get some tax relief on your tax return. The EIS, looking at EIS, the maximum that company can reach, the raise is 1 million, and if you put 10,000, you get 30% relief on your tax return. And obviously, if that company pays a dividend, there's no relief on the dividend, so you'll have to disclose that dividend on your dividend income. But if that company didn't work out, if we made a loss, again, you get a relief on those loss also. Capital gains, and if that company goes up in value, and if you sell those shares out 3 years, there's no capital gains tax either. So it's very popular among a lot of the investors. CIS, again, similar things, but only difference is, the company was asking you money cannot raise more than 200,000. So a lot of the companies will start with CIS and then go into EIS. The difference is on CIS, the relief is much more significant. So you get 50% relief rather than 30% relief. And again, you have to pay tax on dividends if you earn dividend from those companies. And there is reliefs available for losses that made on CIS investments. Capital gains tax, same as CIS. If you sell the shares out 3 years and make a gain, there's no capital gains tax. VCT is similar to EIS, CIS, but the main difference is the venture capital trust fund. So as I told you, EIS and CIS might be only on one particular company, whereas VCT might be combination of 10, 15 companies. So it's a fund. So, one company might go up, one company can down. So you're basically reducing your risk by, portfolioing together. So on those ones, the, maximum allowance is 200,000, but the relief is 30%. The main point there is, main difference is any dividends you earn on VCT did not pay any tax. So that's tax free. If you make any losses, unfortunately, you can't take relief on it, because the idea is when you combine multiple companies on a trust fund, the risk is quite low. So there's no relief for losses on capitals. Capital gains tax, the VCT, you can't sell the VCT within 3 years. So you can. It's tax free as long as you hold it for more than 5 years, right? So you can't sell it within 3 years, because if you have come out of your positions on VCT within 5 years, you will also lose this 30% relief that you gained earlier. Self-assessment file requirements and key dates. I've already covered, who needs to file self-assessment and what it consists of, etc. So the deadlines, very important. Remember, a lot of us submit through software, so the paper returns are quite outdated, but there are still people who submit through paper returns. So if you're submitting a paper return, 31st October is your deadline. But if you're submitting online return, 31st January is the deadline for the previous financial year. So 31st January 2025, the deadline is for 23-24 tax returns, right? So it's very, very important to remember. Payment deadlines. So you need to pay the tax also on the same day. So any payment due on that day, you need to pay. Payment on account. So payment on account is, again, a lot of questions I get on this one. So payment on account is if your tax bill, because HMRC does not want you to wait to understand how much tax and paid. They want you to pay those taxes in advance. So if your last tax bill is about £1,000, HMRC assumes your tax bill is going to be similar next year, so they expect you to pay some advance payments, and they give you two options. One is to pay half of it on 31st January, another half on 31st of July. So ideally, if you finalize a lot of the affairs before 31st July, you will for certain know how much tax bill is. So, you don't have to pay the 31st July as long as you pay the full tax for that year. Common mistakes avoid missing the deadlines. We chase a lot of our clients with WhatsApps, emails, text messages, etc. So don't wait till last minute to send this information. Please send this information ASAP. Inaccurate information. We've recently had an inquiry from HMRC, so some of the clients who omitted, giving us P11Ds or giving us information on the child benefit, etc. So, anything from the company, if you're having the company with us, we would know the income that you're earning from the company. But if you have stuff that outside of company, and if you have like foreign income, etc., it's important you disclose these things for us to file the tax return. Omitting the income, people assume nobody's going to find out about foreign income because HMRC does not have resources to do it, but that's completely wrong. For example, if you have income in India, India and UK have something called a common reporting standard, so they're on the same. They're on agreement where they data share, between both parties. So we've been getting a lot of our clients been getting a lot of penalty letters saying that you have income in India, but you've not disclosed those income in UK. So very important, you disclose those stuff in UK tax return. A neglected deduction, there might be release allowances available for you, so don't neglect them. For example, pensions. If you're on a PAYE and if you're on Nest, for example, you might be able to claim some additional relief. So it's very important you discuss them with us, and we can help you make those claims on your tax return. Penalties, nobody likes this word, but it's my duty to give a bit of understanding how much this will be. If your return is at least a day late, you'll get £100 automatic penalty. 1 day to 3 months, 10 pounds per day, so it can go up to £900. And 3 to 6 months late, additional £300, top of £900, and they also can charge 5% on the tax due, whichever higher. More than 6 months, additional 300, again 5% on the tax due, whichever higher, plus potential further penalties. And also the interest, right? So one thing we didn't mention here is the interest. So important to remember the interest and the penalty on the payment. So there's two penalties. One is for late filing, and the other one is for late payments. It's not the same thing. People assume it's the same thing. So 1 day late, 5% of the unpaid tax. 6 months late to pay your taxes, 5% of the unpaid tax. 12 months later, 5% of the unpaid tax. So it's very important you remember that. Key changes that happened recently, again, just highlight something will happen. Definitely a lot will happen after the budget, so watch out this space. Personal allowance didn't go up for last few years. It's been frozen for a few years, even though inflation is in a significant high last few years. The personal allowance didn't go up in the same way. So obviously the tax is going to be high on the income that you're earning, right? Income tax thresholds, again, 40%. The high tax threshold didn't go up for some times. It's been kind of 50,000 stagnated for a few years. And additional rate was reduced from 150,000 to 125,000, which means the person earning more than 125,000, they're going to pay a significantly higher tax compared to previous years. Dividend allowance used to be £1,000. That's reduced to £500, and capital gains tax again reduced from 6,000 to 3,000. Yeah, that's it. I know I briefed past a lot of stuff. Especially the foreign taxes and domicile part is a very deep topic. I think we need a webinar to cover that, but I just briefly covered some points. I'm sure a lot of you will have some questions. So I'll open the floor for your questions. You can either ask the questions on your chat, or you can unmute yourself and ask on this one.